What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends impacting investments. I'm your host, Devan Nathwani, portfolio strategist within the BlackRock Investment Institute. And this week, I'll be discussing our strategic or long-term views of 5 years and beyond. Government bond yields have surged this year, with long-term US yields hitting 16-year highs in August. We think short-term government bonds now appeal more to us than investment-grade credit over the long run. Yet we still see risks to long-term bonds. Here's why. The yield rise in short-term bonds has closed the gap with credit yields, making income roughly comparable. Short-term bonds also weather changes in interest rates better than credit. Aging populations and the low-carbon transition, two megaforces we track, will likely keep pressure on wage growth and boost energy costs. We think that means central banks will lean toward tighter monetary policy to fight inflation. We also see megaforces, structural shifts driving returns into the future, keeping inflation persistent. Aging populations and the low-carbon transition, two megaforces we track, will likely keep pressure on wage growth and boost energy costs. We think that means central banks will lean toward tighter monetary policy to fight inflation. We stay cautious on long-term bonds. That's because the compensation investors demand for the risk of holding long-term bonds remains negative. In fact, we see risks providing further upward pressure on bond yields. In particular, persistent and volatile inflation could see long-term bond yields rise further. Here's our market take. We see three reasons long-term bond yields and term premium can climb higher. First, markets may price in inflation settling above central bank targets of 2% in the long term. Second, investors may demand more term premium to reflect greater risk in nominal bonds due to higher inflation volatility and rising debt levels. The US credit rating downgrade last month underscored the fiscal challenges ahead. Third, foreign demand for long-term treasuries may wane. For example, Japanese investors may switch to domestic bonds as the Bank of Japan further lifts its cap on long-term yields. To turn positive on long-term bonds, we would need to see term premium rise much more or think market expectations of future policy rates are too high. We are not there yet. We think the new volatile macroeconomic regime calls for more nimble and dynamic strategic views. We trim our underweight to develop market nominal government bonds, to lean into short-term maturities, and go underweight high-quality credit. We still favour inflation-linked bonds as we expect more persistent inflation. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This material is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com/thebid.